Hello, my name is Mike Panamero from Pivot Financial. Thank you for taking the time out of your busy day to join me here. The core mission of Pivot Financial is to make the daunting task of finding more immediate working capital easier for small and mid-sized businesses across North America when bank financing is not an option. One of the ways we continue to deliver on this mission is providing information to businesses through public forums, live workshops, blogs, to industry organizations, trade associations, and the chambers of commerce. During this short presentation, you will learn about 4 alternative working capital solutions that have been designed to enhance the cash flow of most businesses. If you have any questions, please be sure to write your questions down. If for some reason I don't answer your questions with the pertinent information I am about to share with you, I will post my contact information at the end of this short presentation. A recent study by the Credit Research Foundation reveals that over 82% of all businesses are reporting poor cash flow. These companies cite the lack of available working capital, the tightening of cash flow, and the slowdown in customer payments as the 3 major issues that are having disastrous effects on the viability of their businesses. And here's what we know. Companies large and small across this country every single day are delivering products or rendering services. In order to be competitive, they can't always insist their customers pay COD, cash on delivery. So in addition to providing the product or rendering the service, they issue an invoice. Now I'm sure you know what an invoice looks like, but let me bring your attention to an important section of this invoice identified by the little green box called terms. Typical terms in business, typical terms offered by a vendor to their customer to motivate the customer to pay early is 2% 10, net 30 days. What does that mean? Well, if a customer pays for the invoice in 10 days of receiving the invoice, the customer will receive a 10% discount off the total value of the invoice. If the customer pays for the invoice after 10 days and before 30 days, the customer is required to pay for the invoice in full. So the vendor issues an invoice to their customer and now they wait. What are they waiting for? Well, they're waiting to get paid. They're waiting to get paid 30 days, 60 days, 90 days, and even longer. Did you know that the national average for invoices to be paid across North America is a staggering 73 days? Did you know it's estimated that small businesses across North America carry over $825 billion in invoices at any given time? While these companies are waiting to get paid, other orders are coming in. While these companies are waiting to get paid, they have to find new ways to fill their orders, to pay their employees, to pay their suppliers, to pay their fixed costs and keep current with their taxes. And this vicious cycle continues to happen every single day to small, medium, and large businesses around the country. By using a service called receivables financing, a business can receive up to 95% of the total value of the invoice immediately after the invoice has been issued. This in turn creates immediate, continuous, predictable cash flow a business needs on a daily basis to thrive. So the definition of receivables financing goes something like this. It is the purchase of business to business or business to government accounts receivable which are current or outstanding invoices for goods that have been delivered or services that have been rendered in the past for a discount fee. It's important to understand that receivables financing is not a loan. There is no interest incurred, and it's similar to a cash discount that the vendor will offer their customer for early payment of the invoice. Remember that 2% 10, net 30 days that we just talked about. So how does receivables financing work? Well, there are 2 key disbursements associated with a receivables financing transaction. The first key disbursement is called an advance, and the second key disbursement is called the reserve. The advance takes place when the business, the vendor, receives up to 95% of the total value or the face value of the invoice when the invoice is purchased by the funding source. The reserve is when the business, the vendor, receives the balance once the customer has paid for the invoice in full, less the discount fee that is charged by the funding source. To illustrate how receivables financing works, I have prepared this simple example for you. Let's say, for the purposes of my example, the business, the vendor, issued an invoice to their customer for $10,000. And let's say the receivables financing funding source decided it was going to advance 90% of the invoice. 90% times $10,000 equals an advance of $9,000. When you subtract $9,000 away from $10,000, you're left with $1,000, or 10% of the invoice. This $1,000 would be paid back to the business, the vendor, less the discount fee that the funding source would charge. Discount fees are determined by two things: the creditworthiness of the customer and the length of time it takes for the customer to pay for the invoice. For the purposes of my example, let's say the funding source determined that the discount fee was going to be just 1.5% for every 30 days the invoice was outstanding. And let's say in the perfect world, the invoice was paid on the 30th day. The funding source would take 1.5% times $10,000 equals a discount fee of just $150. This $150 is subtracted from the $1,000 that's still owing to the business, the vendor, and $850 would be credited back. So in the beginning of the transaction, the business, the vendor, would receive $9,000. At the end of the transaction, the business, the vendor, would receive $850, a total of $9,850, and the discount fee would be just $150. What is important to note in this example is the 1.5% discount fee is a lot less compared to the traditional 2% 10-day payment terms offered by the vendor to their customer to motivate the customer to pay faster. And in this example, the business, the vendor, received 90% of the invoice immediately after the invoice was created, instead of waiting or having to chase their customer for payment. There are many benefits associated with a receivables financing facility. The first is the business can obtain cash without creating debt. It follows a quick, convenient, and simple process to implement a receivables financing facility into your business. It usually takes just 3 to 7 business days to set up the service. The credit limit increases with the value of the sales. New startup to established companies can now extend credit terms to increase sales with the understanding they can receive up to 95% of their money immediately after the invoice has been created instead of waiting for payment. Receivables financing is ideal for new startup companies to non-bankable businesses because the service does not require strong financial statements to use the service. Remember, credit decisions are based on the creditworthiness of the customer and the length of time it takes for the customer to pay for the invoice. So let's talk about contract financing. Contract financing is a financing facility that provides up to 90% of the value of a term contract for services to be rendered in the future to a creditworthy customer. This solution is ideal for SaaS companies, for tech companies that provide software services, analytics, data management, etc. to their customer under a term contract. The contract could span over a few months, 6 months, 12 months, or longer. Under the terms of the contract, the SaaS or tech vendor is getting paid a set sum of money each month for the services that are going to be rendered against the total value of the term contract. The SaaS or tech vendor is looking to finance against the total value of the contract instead of waiting to collect payments each month. Okay, so let's talk about a financing solution that is ideal for importers, exporters, wholesalers, distributors, agents, marketing companies. It's called purchase order financing. Purchase order financing is a short-term financing facility that provides 100% of the cost associated in filling a firm purchase order from a creditworthy customer for a finished good. To illustrate how purchase order financing works, I have prepared this simple example for you. Let's say we have a distributor of bottled water, and that distributor received a large purchase order from a creditworthy customer for $100,000 worth of bottled water. The cost of the bottled water is $50,000, and the supplier of the bottled water wants payment before the bottled water leaves their facility or their plant. The issue: our bottled water distributor does not have the $50,000 required to pay the supplier for the bottled water. In this case, the funding source will pay the $50,000 on behalf of the bottled water distributor directly to the bottled water supplier, so the order can be shipped to the customer and invoiced. This transaction now turns into a receivables financing transaction. So in this example, the advance rate was set at 90%. 90% times $100,000, which is the total value of the invoice, equals an advance of $90,000. Except in this case, the funding source would like to be repaid for the cost of the bottled water, $50,000, plus the purchase order finance fee of just $1,000 that was charged in this transaction. The fee was calculated by multiplying the purchase order financing fee of just 2% times the cost of the bottled water, $50,000. When you add the $50,000, the cost of the bottled water, plus the $1,000 purchase order finance fee together, you would get $51,000. And this $51,000 is subtracted from the original advance of $90,000. This equals a total advance of $39,000 being advanced to the bottled water distributor. The reserve amount is 10% of the invoice, or $10,000, and the bottled water distributor would receive this amount back after the customer has paid for the $100,000 invoice less the receivables financing fee, or the discount fee. A win-win situation for the bottled water distributor. From not having any money in the beginning, not only was the funding source able to provide immediate working capital to pay for the bottled water, the distributor in this case received an additional $39,000 in working capital immediately after the invoice was created. Okay, the last working capital solution that I'm going to cover during this presentation is called supplier credit financing. The definition of supplier credit financing goes something like this. It's a short-term financing facility that provides 100% of the cost of the raw materials to be used in manufacturing a finished good for a firm purchase order from a creditworthy customer. This type of financing is ideal for manufacturing companies that currently have bank financing in place, but the manufacturing company has exhausted the working capital or operating line of credit that the bank provided and now needs an increase in working capital to buy raw materials to be used in manufacturing a finished good. In this scenario, the funding source can step in and act as the customer and purchase the raw materials for the manufacturing company. The manufacturing company decides when it will pay back the raw material purchase plus the supplier credit financing fee in 30 days, 60 days, or 90 days. The great thing about this facility is the bank maintains its first position filing under the terms of the General Security Agreement or the Personal Property Security Agreement, giving the manufacturing company the ability to increase sales, improve the financial statements that over time will help qualify the business for more bank financing. So in conclusion, to set up a receivables, contract, purchase order, or supplier credit financing facility in your business follows a very simple process to get started with limited paperwork. And best of all, your business can receive a no-obligation proposal within 48 hours of submitting the paperwork. To set up one of the facilities usually takes just 3 to 7 business days. If you have any questions or you would like to speak with me personally, here's my contact information. My direct line is 416-998-3863. My email address is mikep@pivotfinancial.com. That's MIKEP@pivotfinancial.com. Please be sure to visit our website at www.pivotfinancial.com. I hope you enjoyed receiving the information as much as I did presenting it to you. Thank you again for taking the time out of your busy day to watch this presentation. Until I speak with you again, bye for now.